rules. Money rules. Money. Welcome to the Money Rules podcast, where we tackle your personal financial matters with leading financial advisors. Your host, Boitumelo Ntsoko.
Should you house your investments in a trust or a company? That's the question we're tackling in this episode. Each structure offers distinct advantages and potential drawbacks, and choosing the right one can significantly impact taxation, estate planning, and asset growth. To help us navigate this, we're joined by Elke Brink, a wealth advisor at PSG Wealth. Welcome, Elke.
Thank you so much for having me, Boitumelo.
Elke, why do investors need to consider different ownership structures for their investments?
When it comes to different vehicles used in a portfolio, I think there's never one right or one wrong answer. And in principle, I think the ideal portfolio over time would include a combination of many different vehicles. But I think it is important to understand how the vehicles differ from each other. And when it comes to taxation, to also just be aware of certain effect within the different vehicles, as they all have different rules. I found with the end of this tax year that many investors tend to forget that certain investment vehicles like a trust and a company structure, although they offer a valuable role within a portfolio, they can have quite an intense taxation effect on an annual basis when it comes to growth that happens within this vehicle. And it's just because it works differently compared to an individual or within a different type of structure where growth, for example, is maybe not taxed at all, like within a retirement vehicle or within a tax-free investment. So I think understanding the differences and just very well defining again why we have the different vehicles, but also managing how you use them in your planning.
Now, many investors aren't sure whether to hold their properties in a trust, a company, or in their personal capacity. Can you explain the fundamental differences between these structures?
Yeah, so I think when it comes to the different vehicles we use, and I'll get to the vehicles in personal capacity now, but in terms of a trust and a company structure, or in many cases, the combination of both of them, they offer a very valuable continuity planning role in a portfolio. So something like a house or a property or a physical asset is in many cases actually the ideal thing to structure within one of these vehicles, or sometimes a combination, because these vehicles are excluded from your estate for one reason. So let's say there are a few trustees and you have a family and the ownership would have been in my name. Let's say I own the house and I pass away. Now it's a whole estate process and the winding up of the estate where should an entity have been the owner and you have other people involved in the entity, fellow trustees, beneficiaries, if it's a company, there are fellow directors, then you ensure continuity of this asset. There are, of course, within a company structure also, in certain cases, certain tax benefits. So you then have the company tax scale that you're working on. The trust has a different tax scale. But in principle, I would say out of an estate planning point of view, these are excellent structures to use.
You mentioned that there's often confusion about taxation regarding these vehicles. Can you delve into the details of how trusts and companies compare in terms of taxation?
Yes, so I think comparing these different vehicles is an important thing. And to really optimize your holistic picture, sometimes you need to combine them. And I think you also need to limit certain exposures within a company and a trust when it comes to tax specifically or growth taking place. So if we look at a company to start off with, anything that basically accumulates within this company on an annual basis is seen as a profit. So even if you have cash lying there and you're earning an 8% yield on the cash, you will have to pay 27% tax at the end of the tax year, basically on this profit that you essentially accumulated. The same applies to a trust. So anything that is seen as growth, it can be cash, it can be an investment that has equity exposure. So if you, for example, within a company or a trust structure earned a 20% growth on an annual basis out of a taxation point, that's not very fun. So now on an annual basis, you have to either pay 27 or 45% tax on this growth earned. And it has to happen annually. So this is not really the same way as an individual, depending on the structure. Many investment products that you can structure in your individual capacity firstly only triggers tax in many scenarios when you withdraw the investment. So not necessarily on an annual basis that you trigger tax continuously, and I'll expand on that now. But on the other side, certain investments also hold the benefit that you are not taxed on your growth within that portfolio at all. You also have much friendlier scales in many scenarios. So there are certain products, and the first that come to mind is, of course, a tax-free investment. As the name states, there will never be a tax implication on this portfolio. So you just have certain limits that you cannot exceed, your annual 36,000 and 500,000 in your lifetime. But basically, you can earn compounded growth, 100% in equities on this type of investment for many years and not pay any tax ever. Then we look at something like a retirement vehicle. So this can be a pension fund or a provident fund at work. It can be your retirement annuity in your private capacity. All growth essentially built up in this vehicle has no tax effect at all. So you can accumulate for as long as you wish to until you wish to retire. And your contributions are also tax deductible, which is a nice add-on benefit here. But for the topic of this conversation, the growth within the investment is not taxed at all. Only one day when we convert it and you retire will we start earning an income and then only pay marginal tax on your income. We also have other investment vehicle options, more accessible type of vehicle options as individuals. One vehicle I am quite fond of is referred to as a sinking fund. We also have an endowment structure, but they have a bit of a difference at time of death. I quite like a sinking fund. Essentially, on a local front, you can cap income tax at 30% and capital gains tax at 12%. So if you were, for example, only in equities, you would only fall into the 12% capital gains tax scale, and it would only be triggered when you withdraw the investment. So again, if you are saving in this investment for many years and essentially not really withdrawing from it, you're actually not triggering or incurring any tax effect at all. There's also a global version on this product where essentially everything is seen as a capital gain, even if you are in cash exposure. So everything in the global front can be essentially limited to a 12% tax effect. So I think having these different vehicles in mind, in terms of sometimes friendlier tax scales on an individual basis, and yes, there's definitely a very valuable place for a property and a trust. I think for physical assets, as we refer to, I think if you have a family you want to protect, I think with those type of structures, the main goal behind it is always to protect the beneficiary. Or I think that's a very large reason for structuring it. So if you have minor children, if you have a disabled child and you perhaps need a special trust, so there's a very valuable role for it. But it's definitely, I would not see it as a vehicle to use for building your wealth within something like that. So that's just something to be quite wary of when wealth or returns or cash starts to accumulate in those type of vehicles.
Olga, just sticking with estate planning, what happens to assets held in a trust or company upon the investor's death?
So here it always becomes quite important exactly how it's structured, and they can be different forms. But in principle, on a company, there would be multiple directors. So that is quite important just in terms of how you structure it to, of course, ensure that you're maybe not the only person. Otherwise, there's not a lot of continuity taking place. And then on the trust front, you can have other trustees, but you can also have beneficiaries on a trust. So the trustees are essentially the people that would make the decisions on the assets of the trust. And the beneficiaries are essentially the individuals who can benefit from whatever the Trust Act then says. So a trust becomes a bit more complicated because you, of course, typically there would be trustees that you can select, but there's always, in most cases, an independent trustee as well. And then there can be requirements. And this you can define to the T in your Trust Act. And this can be, for example, I have minor children and they need to be taken care of until the age of 25, as an example. So this becomes a great vehicle for the right use. I think with a company and with a trust, it's always just important to also remember compared to an individual capacity, that you are essentially stepping away from your asset in terms of it's not in your own name anymore. So you are giving a little bit of the control away of your asset. But within reason, of course. But I think it's just something to be aware of before. I think investors sometimes want to too easily structure vehicles that are maybe not the appropriate vehicle for their needs.
How easy is it to access and manage investments within a trust or company? You touched on it a bit earlier regarding trusts, but can you go into it a bit more?
I think in principle, depending on exactly how you structure it and who the other people are that also form part as decision makers. But there's a lot of legislation when it comes to these type of vehicles that you have to abide by. So it needs to conform to certain legislation. Of course, company has Company Act, and a trust would always depend on other trustees, of course, and the goal of the trust. So the trust needs to always be structured for the correct reason, and you have to basically have the sign off, if I can call it like that, of the other trustees as well in terms of decision making. There are certain cases when you, of course, also would need, if you want to make an amendment, for example, certain things need to, in a formal matter, go through a master's office, for example, if you want to change a trustee or something like that. So it can be a little bit more complicated in terms of changes. Maybe to touch on your previous question, I think why this sometimes has a great benefit with continuity is for me, I think personally, at time of death, in terms of ensuring that this asset does not go to your estate. So let's use the example of I have a direct share portfolio in my name, but it's just in my personal name, and it's not in a type of a wrapper vehicle like a sinking fund. Then this would essentially go to my estate, and this would be tied up in the estate until the estate is wound up, and then only divided according to my will. So if there's any delay in this process, my share portfolio might get stuck in the winding up of the estate for a year or even longer. Some estates take up to 4 years to wind up. So if I have someone who is dependent on this money, this is not the ideal route to go. So with certain assets, and like we referred to a fixed asset, maybe a house, someone needs to continue living in the house. They do not want to go through this whole process before they can essentially buy the house out of the estate and continue ownership of the asset. So it offers a great value in terms of estate and continuity planning, either in a business or in a family, or between spouses, to just ensure that continuity. But I think the reasons for it should always just be very well understood, and what the possible implications are as well.
Now, what should investors consider when deciding whether to use a trust, a company, or to hold investments personally?
I would definitely advise a full financial analysis on this, which you can do with a tax advisor together with your wealth advisor, because I think the combination goes hand in hand with optimal tax advice and optimal investment advice. So on the investment side, of course, the more optimal you're managing the investment and the better the growth. In certain vehicles, you actually don't want all that growth. For example, in a trust or a company, all that growth is not always a good thing. When a private capacity, it can be fantastic. So I think having this form of advice, and I think many investors are not always aware of exactly what the outcome is they want. If they, for example, just want to be sure that their spouse will inherit the funds or their children will inherit the funds, you can in many cases use a different vehicle. You don't necessarily need a company or a trust for that scenario. You can use a sinking fund or another type of investment. So there are many investments that you can structure in your private capacity or in your individual name that will anyway go to your beneficiaries directly should you pass away. So it's much more affordable and much less complicated sometimes than structuring, for example, a trust with many other parties that need to sign off on the decision making when it's not necessarily the need for the outcome you want. But yeah, I would definitely advise doing a full analysis and also understanding the costing and everything that goes with it. So with a vehicle like a trust and a company, of course, you need audited statements every year. You need a few things you need to abide by to make it a legally correct structure, which can become quite costly if it's not necessarily the optimal vehicle for your specific needs.
Alka, you've mentioned tax-free savings accounts, sinking funds, and retirement annuities as alternative options to using a trust or a company. Are these the only options available to investors, or are there other alternatives?
There are definitely a few other vehicles that investors can also have in their private capacity. I think these are some of the more tax-friendly ones when it comes to growth you can expect within the investment. It very much depends on where you build your wealth. So other forms of investments that typically occur in an individual name is a direct share portfolio, or a normal, what we refer to as a voluntary investment or an accessible investment. And these are typically structures that are completely accessible. They don't really have a lot of rules around them. But here you are exposed as an individual to normal capital gains tax rate of 18%. And let's say you have cash or bond exposure, which is seen as you have an annual exemption on interest earned, and anything over and above your exemption would be seen as an income, so taxed at your marginal rate. So here I would just be careful if I fall into a higher marginal rate bracket to not be too exposed to something that is interest bearing. So this typically happens to investors also who have a lot of cash in the bank, for example. It almost comes from a conservative side to be safe in cash, but it has a negative tax effect. So that's also something I would be careful for in an individual capacity. So I think in terms of defining what your goals are in your portfolio and then doing a tax and a wealth analysis on it. So by combining a few different products, you can essentially manage and optimize each product's tax benefit. So let's use the last example. If I were very exposed to cash, but I maybe fall into the 45% tax bracket, it would be more optimal for me to put this cash into something like an endowment or a sinking fund where you can cap your income tax effect at 30%. So automatically bringing your tax effect down with 15% just by using a different vehicle. So you don't necessarily have to move out of the cash if that is there for a reason, but you can be in a more optimal structure. So I think it's important as we build wealth to ensure you bring advice into the decision making from earlier on. Because with anything, any of these decisions within an investment portfolio, sometimes changing the ownership or the vehicle later on becomes more difficult, because then you essentially need to sell off an investment and incur tax or costs to be able to change the vehicle that it's in. So my advice would definitely be to try to structure the more optimal vehicles earlier on in life and rather start building the wealth within those vehicles.
Just before we wrap up, what would be your key takeaway, just adding to what you've mentioned, for those looking to structure their investments efficiently?
I think when it comes to any individual that potentially either already has or wants to structure something like a company or a trust is to ensure you gain advice in terms of if this is even the appropriate vehicle for what you're wanting to achieve. And then I would recommend doing a full advice session in terms of planning where are you going to place your assets within the different vehicles. Is it not better to use something in your private capacity, but perhaps having your trust as a beneficiary listed on this product? So let's use an example. If you build wealth within something like a sinking fund for many years, which is in equities, and I'm essentially not incurring any tax at all, but the trust is the beneficiary. So should something happen to me, it can go to the trust where the minor children and my spouse is nominated. So you're essentially just not building up the wealth in the trust where you're paying 45% tax continuously, but you're basically doing it in a more tax efficient way. So I think having this advice just in terms of maybe using more optimal products. And I think if you're already in a position where you have wealth or even just cash that's building up in a company or a trust, and this is starting to cause a tax irritation at either 27% or 45% tax rate, I would just ensure maybe there's a way to structure it more optimally. And speaking to a good tax advisor together with your wealth advisor will definitely be recommended.
And that brings us to the end of this episode. Thank you so much, Alka, for joining us today.
Thank you so much for having me.
That was Alka Brink, a wealth advisor at PSG Wealth.
Thanks for listening to this episode of the Money Rules podcast. To listen to more, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Moneyweb, your trusted source for business and investment insights.